Welcome to the Global Income Q1 2026 update. I'm Refiloe Modise, and today I'm joined by Mark Seymour, who's the manager of the Global Income Fund. So Mark, over the quarter we saw a lot of volatility in the market. Asset performance across the board was weak, so we saw front end of the US Treasury curve perform quite well with returns just below 1%, but the long end underperforming, down 2.5%. We saw that the GLAG was down 1%, high yield global credit was down 4.9%. If we take a step away from fixed income instruments and we look at commodities, gold did perform well and returning 7.8%, and of course we saw what the oil price did. But in this environment, do you think diversification worked in Q1?
Yeah, so that's Q1 was a really tough period for all asset classes. The only, like you say, the only asset class that went up is oil, the oil price. And you mentioned that gold did well during the quarter, but during the month of March, during the heightened event or the war event, gold was down 10%. So certainly the cash was king, and diversification didn't amount to much at all. So a really tough period for multi-asset products.
Okay, so if we consider the fact that the Global Income Fund sits within the EAA cautious USD category, which the objective there is capital preservation with the low to medium risk tolerance, where do you see current opportunities evolving to generate income returns or capital returns?
Okay, so during this event, the fund is down just over 3%. And if you look at a history of the typical blend of assets that we've got, it's well within the normal range of portfolio behavior, which is, I think, quite impressive given that we've just had an extreme event.
Correct.
So with having said that, I think we've fared really well, given our large exposure to short-dated treasuries and also predominantly USD assets. So in a sense, from a risk management perspective, our valuation work pointed us in the right direction. And then just in terms of the opportunities going forward, the fund sits in that category, which allows the fund to have an equity component. The fund is designed to try and deliver a 2% real, and so with that, our neutral weighting to equities is in the order of 25%. We're sitting at 20%, so we are underweight equities, which had a really tough quarter, and specifically the portion, the Northstar global equity portion, had a tough period, even versus peers. So in terms of opportunities, that's where the largest opportunity actually lies. Sitting in 20% global equities, the Northstar global buy list, and there are plenty of companies on fantastic earnings, strong balance sheets, strong cash flow generation is the main opportunity. Outside of that, the fund maintains quite a large exposure to dollars, to USD. And then within that, the exposure to US Treasuries. Now, over the last couple of months, we've been looking at extending duration, and so at a portfolio level, we've gone from just over 2 years maturities on average on a weighted basis, and then over the last little while, we've seen that creep up to closer to 3.5 years. And then with this event, our optimization exercise is calling for even more exposure. So we are extending out on the curve as those longer dated yields rise. And so that's the next main opportunity set. And we think that makes a lot of sense on yields that on a buy and hold basis give you 1.5-2% real return in terms of stacked up against US inflation. And so the fund, when you stack it all up, that's on really decent prospective returns.
Okay, so given the fact that there's elevated volatility, uncertainty around the likely path of inflation and growth globally, how does that translate then into expected returns across the different asset classes?
Yeah, so certainly there's a challenge in terms of the path of interest rates and inflation both those macroeconomic measures, the consensus been challenged. And with that, we put those new adjusted numbers into our models. And so, the expected returns out of US cash creeps up a little. And then certainly longer out in the curve, we need to be a little more cautious about the expected returns there. But if we look at how those all stack up, like I say, the returns looking still really decent. Certainly what does come into play now is US TIPS, so inflation protected securities. They're on real yields of 1.5 up to almost 2%. When you start factoring in potentially higher inflation, specifically maybe over the next year or year and a bit, as this whole event plays out, those start looking attractive. And then in terms of the overall challenge, yes, we need to think about the impact that higher inflation and higher interest rates might have on our equity portfolio. But with that, we've seen that intrinsic value discount widen to such a point that even at current levels and the current inputs, returns in the order of 15 plus returns. And so, when you stack that all up, the Northstar Global Income Fund benefiting from higher yields, yes, but certainly there's a capital element as well. And so when you add those two together, we are looking at about an 8% return. And certainly when you stack that up against the inflation, albeit at a potentially elevated level, maybe 3%, slightly higher than 3%, but certainly over a multi-year view, that should moderate closer to the Fed's target. That means, on an after-cost basis, a 4 or 5% real return. And we're actually only targeting essentially or trying to achieve a 2% real return.
Yes.
And even with that makeup, we've got a portfolio that's pretty well diversified and a quite low risk.
Perfect. Thank you so much for your insights, Mark. I think it's great to see and understand that through the quarter, diversification didn't offer the protection that most people thought it would have. So where do you find comfort as a manager in terms of maintaining capital preservation within the Global Income Fund?
So there we need to be very certain that we don't take on too much risk in either one of the asset classes. We've just seen that there hasn't been a lot of diversification benefits, so the importance of actually holding cash.
Correct.
And holding cash in this environment is actually not a bad idea. You've got the Fed's fund rate at a pretty decent level, which is appreciably above the current level of inflation. So you're getting inflation protection even at the get-go.
Correct.
And then other considerations is making sure that the equity portfolio portion itself is well diversified. So that's key. And then other elements, traditionally we would potentially hold other asset classes like gold,
Correct.
which we've done in the past. But gold has got beyond the price target that we've set, so we're quite cautious to be holding gold. But certainly we are constantly looking at trying to introduce some element of diversification. And so the latest theme might be inflation-linked tips, making sure that it's a continual process.
Perfect. Thank you so much for your insights, Mark.
Great.